What if your Bitcoin could pay you income every month, like a dividend? That sounds impossible. Bitcoin doesn't pay dividends. It just sits there. You make money when the price goes up, and you lose money when the price goes down. That's it. No income, no coupon, no yield. Except BlackRock just launched a product that changes that, and it's about to force Canadian investors to ask a question they've never had to ask before. Do I want income from my Bitcoin, or do I want maximum growth? I'm your crypto compass. Let's get your bearings. In this video, I'm going to explain exactly how BlackRock's new Bitcoin Yield ETF works. In plain English, no finance jargon, and what the trade-offs are, whether it makes sense for a Canadian TFSA, and what this tells us about where Bitcoin investing is heading. Stick around, because by the end of this video, you'll understand a new category of Bitcoin investment that most Canadians don't even know exists yet. And I'll tell you the exact date you might be able to hold a Canadian version in your TFSA. Before we get into the new product, let's make sure we're on the same page about how a regular Bitcoin ETF works, because this all builds from that foundation. A standard Bitcoin ETF, like BTCC on the Toronto Stock Exchange or BlackRock's IBIT in the US, holds actual Bitcoin on your behalf. You buy one share of the ETF. The ETF buys Bitcoin. The price of your share goes up when Bitcoin goes up and down when Bitcoin goes down. Simple. You don't own the Bitcoin directly. You don't have a wallet. You don't manage private keys. You just hold a regulated insured security in your brokerage account or your TFSA, and your money tracks Bitcoin's price. That's a regular Bitcoin ETF. It gives you price exposure, nothing more. Now, here's where covered call ETFs come in, because this isn't a new idea in Canada. Canadians have been using this strategy for years on equities. Let me explain it. Imagine you own a house. You don't want to sell it. You think it will be worth more in the future, but while you wait for it to appreciate, you rent it out. The rent check doesn't make you rich, but it gives you monthly income on an asset you already own. That's essentially what a covered call strategy does in financial markets. Here's how it works with stocks, and then we'll apply it to Bitcoin. You own 100 shares of a company. You sell someone the right, but not the obligation, to buy those shares from you at a set price, say $110 before the end of the month. In exchange, they pay you a fee up front. That fee is called the option premium. If the stock stays below $110 by month end, the buyer lets their option expire. You keep the premium and your shares. Next month, you sell another option, more income. If the stock shoots past $110, the buyer exercises their option. You have to sell at $110, even if the stock is at $130. You miss out on the upside above $110, but you collected income every single month along the way. The trade-off is simple. You give up some upside potential in exchange for regular income. That's the whole thing. And this is already a massive category in Canada. BMO's Covered Call Canadian Banks ETF, ticker ZWB, pays monthly distributions. CIBC, TD, BMO all offer similar products for Canadian equity investors who want income. They're incredibly popular in TFSAs and RRSPs because the income is sheltered from tax. BlackRock just built the same product, but for Bitcoin. BlackRock's iShares Bitcoin Premium Income ETF, ticker BITA, just filed its likely final regulatory amendment and is expected to launch imminently in the US. Here's exactly what it does. BITA holds spot Bitcoin and shares of BlackRock's existing Bitcoin ETF, IBIT. Every month, the fund writes covered call options on those holdings. Investors who buy those options pay a premium up front. BITA collects that premium and distributes it to shareholders as monthly income. The income amount varies. It depends on how volatile Bitcoin is. When Bitcoin is volatile, options premiums are higher, so income distributions are larger. When Bitcoin is calm, distributions are smaller. The fee is 0.65% per year. That's slightly higher than IBIT, 0.25% fee. Which makes sense. There's more active management involved in running the option strategy. Now, the critical trade-off. If Bitcoin has a massive rally, say, a 40% move in a month, BITA will not capture all of that gain. The covered calls cap your upside. The people who bought the options will exercise them. And BITA has to hand over Bitcoin at the agreed price. You participated in the first part of the rally, collected your monthly income, but you missed the final surge. If you believe Bitcoin is going to have a slow, steady year, or if you want to generate income during a sideways or mildly declining market, BITA is designed for you. If you believe Bitcoin is about to go on a historic 300% run and you want to capture every dollar of that gain, a standard Bitcoin ETF is a better fit. That's the honest trade-off. Neither is wrong. They're just for different goals. And, by the way, Goldman Sachs is racing to launch a competing covered call Bitcoin ETF, expected around July brights. This category is about to become crowded, which is good for Canadian investors who'll eventually have options to compare. That brings me to the part I think most of you actually care about. If you're finding this breakdown useful, a quick subscribe means you'll catch the next video. I cover Canadian crypto investing every week, and this stuff moves fast. Here's the Canadian angle. BITA is a US product. It trades on a US exchange. You can't hold it directly in a Canadian TFSA, at least not easily, and the foreign withholding tax situation gets complicated. But that's not really the point. The point is, Canadian ETF providers follow the US market closely, and they're fast. When BlackRock launched its US Bitcoin ETF IBIT in January 2024, Purpose Investments in Canada had the world's first Bitcoin ETF, BTCC, already live on the TSX since 2021. When the US catches up on product innovation, Canada tends to follow within 12 to 18 months. So, a Canadian version of BITA, a covered call Bitcoin ETF eligible for your TFSA or RRSP, is likely 1 to 2 years away, if issuers like Purpose, Evolve, or CI Galaxy see demand. And given how popular covered call equity ETFs already are on the TSX, there's a reasonable case that demand will be there. What should you do right now? If you hold Bitcoin in a TFSA through BTCC or EBIT and you're happy with the pure price exposure, nothing changes. You don't need to do anything. BITA is a US product. It's brand new, and Canadian alternatives don't exist yet. If you want to start thinking about whether an income-generating approach would suit your strategy, a good first step is looking at how you already use covered call ETFs in your portfolio. If you hold something like ZWB or BMO's Covered Call Financials ETF and you like the monthly distributions, you're probably the target audience for a Canadian Bitcoin Yield ETF when it eventually arrives. And here's the bigger picture. The fact that BlackRock built this product at all and that Goldman Sachs is racing to compete tells you something important. Institutional investors are no longer debating whether Bitcoin belongs in portfolios. They're now asking, what format should it take? Should it be growth? Should it be income? Should it be both? That's a different conversation than 2 years ago. And Canadian investors are going to have access to all of it. Let me give you a simple framework for deciding whether a covered call Bitcoin ETF makes sense for your situation. Whenever a Canadian version becomes available, ask yourself 3 questions. 1. Is my goal income or growth? If you want to maximize Bitcoin price appreciation over the long term, stick with the standard ETF. If you want regular distributions, because you're in retirement, you like monthly cash flow, or you want to reduce volatility in your portfolio, a covered call structure makes sense. 2. How much upside am I willing to give up? In a massive Bitcoin bull run, a covered call ETF will underperform a standard ETF significantly. In 2021, Bitcoin was up 300%. A covered call version might have delivered 80 to 120%. You need to be comfortable with that trade. 3. Do I understand that my income varies with volatility? This isn't a fixed dividend. When Bitcoin is calm, your monthly distribution will be small. When it's volatile, distributions will be higher. It's variable by design. Plan accordingly. If you can answer yes to all 3, income preferred, upside cap accepted, variable distributions understood, a covered call Bitcoin ETF will probably be one of the most interesting products that arrives in your TFSA in the next 2 years. So, let's pull it together. BlackRock just launched BITA, the world's first major covered call Bitcoin ETF. It holds Bitcoin, writes monthly options on those holdings, and distributes the premiums as income. You give up some upside, you get regular cash flow. And Goldman Sachs is already building a competing version. For Canadians, a TSX-eligible version is likely 12 to 18 months away. In the meantime, understand the mechanics, decide where you fall on the income versus growth spectrum, and watch for announcements from Purpose, Evolve, and CI Galaxy. This is genuinely new territory for Bitcoin investing, and Canadian investors are going to be in a strong position when it arrives here. If this video helped you understand something you hadn't seen explained before, please subscribe and hit the bell. I cover Canadian crypto investing every single week, and this product category is going to be a recurring topic heading into 2027. What would you prefer? Income from your Bitcoin or maximum growth potential? Drop your answer in the comments. I read every single one, and it helps me know what to cover next.